Hi, this is John Malloy, Portfolio Manager for the Redwheel Global Emerging Market Strategy. Hope everyone is well out there. It's clearly been an interesting 3 or 4 weeks since our last update. You could say the world has somewhat changed in terms of developed market central banks, and how developed markets, both in the US and Europe, have reacted to what we've seen in the banking sector and in the brokerage sector. This has implications for emerging markets. I would say actually more positive than negative, that we can get into. In terms of EM, emerging markets have given back largely the gains that we saw in January and earlier on this year, but emerging markets are flat year to date. If we go back from the November period, emerging markets overall rallied 25%, and year to date, or from the peak so far this year, we've given back about 10%. And if you look at China, which, as you know, is the second largest economy in the world, the China index, the Morgan Stanley index, rallied 50% from November until January. And that has given back about half of the returns as well. All of the fundamental views that we had coming into this year are still intact, which is very interesting in light of what we've seen over the past few weeks. In fact, I think they could be better. China is recovering. Colin Lang, our head of China, was in China a couple of weeks ago. China is clearly recovering across the board. Domestically, we're seeing it in many different sectors. If we look at the commodity backdrop, with the exception of oil, looks very strong, and we think that oil will stabilize eventually. If we look at the growth materials theme that we have in terms of copper, even iron ore has held up. Gold has been very strong. Our gold exposure has clearly come through, with gold fields performing extremely well. In addition to that, we do have a view that rates will come down, and we've been talking about that for some time. If you look at domestic rates, domestic interest rates in emerging markets, they actually have been rallying. They're up 3 to 4% year to date. Currencies are stable. This is very different from what we're seeing in other markets. And what we think is happening basically is, given that the Fed is likely done, Cem Akarek, our PhD economist who heads up our economic research, believes that it's very likely that the last hike we saw, the prior hike, was the last hike. There's signs that inflation is coming down dramatically in the US and Europe, and that should be positive for global rates. But more importantly, we have very high real yields in emerging markets, and that should drive bond markets higher. It should push yields lower, of course, and that should move money into equity markets. So our view that rates will be a tailwind in terms of emerging markets, such as what we've seen in Eastern Europe, places like Hungary, what we've seen in throughout Asia, what we've seen in starting to see potentially throughout Latin America, we think is very interesting. In terms of the other themes that we see in the portfolio, they continue to be very well supported. In China, we continue to believe that technology disruption with the advent of ChatGPT will be a driver. We have news this morning that Alibaba will be breaking up into 6 different companies potentially. That's a very positive driver. And we saw that Tencent put out very good numbers in the past week. Just an interesting note on Tencent. Over the past 3 or 4 years prior to 2022, the company had 1,000 game launches. Last year, the company had 80. So just think about the impact of that company going forward and the ability for them to come to the market with new product. We think that technology disruption continues to be a driver. Growth materials will be a driver. But then we're looking at other areas that should benefit. Travel, consumption coming back. We've had names in the portfolio like Sands, China, which has done extremely well. And we're looking for companies and countries that will benefit. We've added exposure to Thailand, for example. And we've also added exposure to some of the other ASEAN markets that are benefiting from not only the recovery, but also offshoring, nearshoring. Outside of Asia, actually, Mexico looks really good in that front. We have a very good exposure in Mexico, and we think that Mexico continues to be a beneficiary of onshoring, nearshoring, in addition to those smaller ASEAN markets. In addition to that, we believe that frontier markets will be in a good position to recover as commodities do well and as rates come down. In terms of the portfolio today, it trades at about 11 times earnings. We have very strong upside of the portfolio, just under 50%. And the earnings growth rate of the underlying companies ends up being north of 25%. So thank you very much for your support. Please reach out if you would like further information.